What is up, YouTube? Matt McKeever here. It's Friday, Finance Friday with the Findlay team. Hey, Josh. Hey, Aaron. How's it going?
Good, buddy. How are you?
Good. So I'm excited just kind of catch up with you guys. You know, it's been a while since we did live together, so I figured let's kind of jump into some topical subject matters. So what are you guys currently seeing in the world of real estate financing? I guess even before you guys pick that up, I'll just kind of frame the conversation. I think right now there's lots of real estate investors that are, depending upon your market, maybe seeing the market catch its breath, or it's like at least not going quite as insane. They're maybe not competing with quite as many multiple offers as they were in the past. So I know a lot of investors now are starting to look, maybe thinking about sniping a deal. So if I'm looking at jumping in the market right now, what should I be aware of from a financing perspective?
Yeah, I think on the purchase side, it's still busy, but I don't think they're getting, 60, 70 offers on a property. I think there's still a decent amount of offers going in. I mean, I guess we kind of have to confirm maybe with the realtor, but I think they're still seeing like 15, 20 offers. Still decent amount, but down from what we were seeing like, early of the year and a little bit going like later in 2020 coming into 2021, where there was, some were going in like 60, 70 offers from what I hear. And some buildings were going, $200,000, $300,000 over asking on some of them. I don't hear as many of those stories anymore, but still seems pretty busy. I mean, we're still getting quite a few offers and firm deals across our desk in terms of just clients looking for pre-approvals and numbers. So still pretty busy from our end. Doesn't like our day hasn't changed much, and we're definitely not getting more free time. So it's still pretty busy.
Yeah, I would definitely say that the market is softening a little bit. There is an opportunity here for people to make maybe more aggressive offers. We are seeing the climate is still calling for, unfortunately, no conditions. Now, obviously, we can't do that, but having your financing in order and having everything in order to be able to execute on a project like that is going to put you in a situation to be more competitive, especially in a market where there isn't as much competition. So it's definitely a softening. I don't know if it's specifically because of the current climate we're in, where everybody's still locked down. When we were when we were allowed to go do life, there was a lot of people making a lot of offers and going to see houses, and then it kind of stopped or slowed down when we got cut off again. So it's going to be interesting to see what happens with the market at the end of this month when people are allowed to go back out and do things.
Yeah. And so for the investors at home watching this right now, let's say that they are still in that hot market, it's going into multiples. They feel pressure to put in a cash offer. Obviously, you guys would never recommend someone put in a cash offer unless they've got cash. But if I'm going to do a cash offer and then try and get financing afterwards, is there anything that I can do to try and set myself up for success? Is there anything that I should maybe keep in mind when trying to play that game? And obviously there's big risks involved with playing that game, but people are going to play it. So how can I maybe try and set myself up for easiness? I'm guessing like if I'm going to put in a cash offer and then turn to you guys to get financing, I probably should have already filed my taxes and stuff like that.
For sure. And I mean, one other kind of caveat to that is if there's an appraisal needed on that building, most of the time, if it's MLS listed, they reach out to the seller's agent to book that showing. If all of a sudden the listing agent's getting a call from an appraiser saying, hey, so-and-so is coming out there to get an appraisal for financing, what happened to the cash offer? So keep that in mind. There are some things that if you're looking to do that,
that's a great point, Aaron. I might just jump in here for a sec. So for anyone at home that is in kind of that situation, oftentimes like if I'm going to make a cash offer, I usually know I can back it up. But if I'm going to maybe try and get financing anyways, because just, hey, why waste my cash? But I want to lock up the deal right now. It is important to manage expectations with that realtor, right? The seller's realtor, and be like, hey, we're good to do a cash close, but I'd like to get financing. So can we have an appraiser come through once the deal's firm?
Yeah. Just save any surprises and any hiccups. I mean, the last thing you want to do is kind of, cheese off a realtor in this market and just have any bad feelings going that way. So yeah, I mean, just let them know, like you said, hey, I have the cash to close, but I'd like to try to get financing if possible. At least that way he's not just hit, out of left field with an appraiser showing up looking to book a consultation.
Yeah, that doesn't go over well too often.
I would say down payment. If you're making a cash offer, at least have 20% in your bank account ready to go. We can make anything happen if you have 20% down. Like and every solution requires at least 20%. So if you have the 20%, you might not have the most favorable terms, but you can at least close in the property. So, ensuring you have the 20% to find a solution is super important, because if you're in a situation where you need a insured mortgage and then you cannot qualify for an insured mortgage and you've made a cash offer and no conditions, you're in a very, very difficult situation.
Mm-hmm.
There isn't anybody who can help you. You're probably going to breach your contract.
Yeah, really appreciate that. And let's talk about the other side of the coin then. Let's say I am going to put in a conditional offer, and let's start with maybe just like your plain Jane residential real estate type property. From your guys' perspective, what's an appropriate timeline for a financing condition in regards of like actually being able to get someone approved?
Yeah, I mean, we would love 7 business days. We understand that that's not always the case. 5 business days. I've never had anything, go with beyond 5 business days. I've never had anything come close to 5 business days. Typically, I see about 3 business days is, a decent and reasonable expectation
And
for turnaround.
Just to jump in there, that this is a client you already know reaching out to you, or would this be a brand new client?
Even if someone, came to me right now and said, "Hey, I got something closing in a month," or, I'm looking at putting an offer in, financing conditions, 5 days away. We could get that, maybe not this Monday, but, submit it on Tuesday and have something probably back by the end of the week, most likely. If you have a good broker, he probably has some sort of relationship with a lender. We are on really good terms with most of the BDMs that we work with. So, it's not abusive, but when you need to get something pushed through on an approval, we can kind of give them the gas a little bit and see if they can kind of get it pushed through. And, for those that need it, but 3 to 5 days is a pretty good turnaround time for an approval, from step one, if we have or have not talked to them before. So,
yeah. And just to, sorry to cut you off there, but just to hit home, that business day, that's an important phrase, right? Because like if I put my offer in right now and I say 7 days, well, if we look at the weekend that's coming up, I lose Saturday because bankers aren't going to work on a Saturday. I lose Sunday because they're not going to work on Sunday, and they're definitely not working on a statutory holiday on Monday. So there's literally almost half of my condition time. Whereas had I used the word business days, like Ehren was saying, my clock starts on Tuesday rather than today.
Yeah. And God forbid you put it in yesterday when half the world's off at, 12 o'clock to noon today anyways, going into the long weekend. So you almost lose a 4th day on that as well too. So
if you take a look at people who are working, or employees who work on Fridays of a long weekend and then Tuesdays of a long weekend, those are write-offs as well. So it's a decently difficult situation to be in if you were trying to get financing. Now, something to keep in mind is this is for residential real estate. Commercial real estate, we're seeing, and most of our clients are putting at least a 30-day financing or waiver clause in, specifically because it takes 4 weeks to get an appraisal. And then the way that banks underwrite is a little bit different. We're going to have to submit it to credit. Credit takes another week. So we're seeing at least 4 to 6 weeks on a conditional period for a commercial purchase. So just something to keep in mind, guys, if you are looking to purchase larger real estate, that 3 to 5 day window is not reflective of how long it actually takes to get some sort of approval from a bank.
Yeah. And there's a lot more in-depth stuff that goes on in the commercial. They have, depending on the door count or the dollar value, it might be a 5-day review just to get the approval. The document teams that, if you're buying in a holding company or anything on these small commercial type stuff, there's a lot more documents to be set up, account docs. The document teams are behind, the credit teams are behind, the analyst teams are behind. Like everyone's just slightly behind right now. So, the business itself of banking and the lenders just aren't meant to be able to keep up with these huge influxes, especially now with COVID and everyone's working from home. It just adds in a little bit of lag time on communication and sending things around. So everything's slow. We're fighting deadlines right now on a lot of stuff, especially refinances. So just, kind of be patient and just understand that we're pushing as hard as we can, and the lenders are doing the best they can to make sure everything closes on time.
Yeah, appreciate that. And then, so just kind of chatting through, there's a lot of headlines, I guess, these days talking about interest rates and, banks or politicians trying to tighten up mortgages. Do you guys mind just maybe sharing some perspective, or is there any like announcements we should be aware of as investors?
Yeah, so June 1st, the new stress test comes into effect for uninsured mortgages. So 5.25% is the new stress test compared to 4.79, which we currently qualify at. Now, as of right now, insured mortgages are still qualifying at that rate, whereas uninsured mortgages, so any B loan or anything you don't pay insurance on, you're going to have to qualify a little bit higher. Essentially, the Bank of Canada came out the other day and was talking about how the average household has taken on a significant amount more debt in the last 12 months than what they usually have. And I think this is their way to kind of try to halt down the amount of borrowing that's happening. I think a prudent person would take a look into how maybe other economies or our economy has come out of recessions before. We're going to have inflation. It's going to happen. Whether people like it or not, inflation is going to happen, probably much larger than what the government is saying. To combat inflation, you need to raise interest rates, and raising interest rates is going to affect the entire market. So I think this is them putting a safeguard in place because interest rates are going to be raising, and they need to make sure that people who are in mortgages or are going to be in mortgages are going to be able to make those payments. So they're stress testing now at 5.25%, which means to me, rates are going to go up, and be prepared as an investor. If you're in a variable, make sure stress test what you have, like in regards to your cash flow. Can your payment, are you underwater if your payment goes up by 2% or your rate goes up by 2%? If not, you might want to look at moving into a fixed as soon as you start seeing the Bank of Canada making some announcements on the overnight lending rate.
Yeah, really appreciate that. And then as far as like interest rates rising, obviously no one's got a crystal ball, but at least you guys can say whatever you feel comfortable saying. I definitely agree with you on the inflation front, that it is inevitable and it's already here. But beyond that, I do still see, I don't know, when I look at any central banker, I still see just a dove dressed as a hawk. I don't know if they've really got the teeth yet to start rising interest rates in a significant manner. I suspect their hand may get called at some point in time. But for me personally, if I was speculating, I would guess that it's going to be well into 2022, in my opinion, before we see any significant movements. Maybe there's a token movement just to show they've got teeth. But any ideas that you guys would like to speculate on?
Best thing is to take a look at what goes on. When COVID first hit and the economy was kind of taking fire, the government put some stuff into place to help the markets. They had the buyback, the bond buyback product that they did, or program, where they're buying, was it 7 billion, or it was in the billions on the buybacks on the bond markets. And they put some programs in place to help the credit lines as well too, right? So Bank of Canada was lending out money quite cheap to help facilitate the credit lines and make sure things were flowing smoothly. The bond buyback program has now been stopped. That was a few months ago now, maybe like 3 or 4 months ago. And the programs that were in place to help the credit products as well too have been recently just stopped now. So they're starting to shift back, like eliminate these programs that they had brought in. So I think that's a sign that they're not there to kind of help the economy anymore, and they think the economy is starting to make that healthy-ish recovery and can start to kind of manage itself. So those are signs. We've already seen fixed rates go up quite a bit, as opposed to the prime or the prime rate and the variables. I think you take a look at what an owner occupied fixed rate right now is, 2.34, 2.4, and you can still get a 1.55 on a variable. So, those are uninsured, but a little bit of a difference. So I think, variable is going to go up at some point. It just has to. The banks want to make their money. They don't want these small margins. They want to have a little more margin.
But I guess just to be clear there, Aaron, when you're saying that you see variables going up, do you think that's banks increasing their margins, or you see that as in the prime rates increasing?
I don't know if the discount rates will change in terms of how lenders calculate it. That that's probably the first thing to change, I suppose. Actually, if I think about it, is how they discount the prime, or how they they add on to the prime. I don't know if prime is going to change right away. I'm sure lenders would make small changes first to how they calculate it, and then Bank of Canada might make some changes later on. It's a good question. I'm not sure what would really change first, but I think prime rates are going to change one way or another coming up in the next year or two for sure, just to keep up with fixed.
I agree. I think the Bank of Canada has already come out and said that they expect to start raising their overnight lending rate in 2023. We had a really good Q1 with our GDP and how the economy was coming back to life, and then we shut everything down again, so it wasn't really reflective of what was happening. But the Bank of Canada at that time came out and said, possibly rates are going to rise a little bit sooner than expected, and then we went through this whole process again of locking down, and the economy has done its thing at the moment. So I think you're probably looking at 2023 before you really have to start adjusting your rates. But definitely something to keep an eye on as a prudent investor if you want to make sure that your investments aren't going to be underwater when that happens. Now, I know we have a few comments here in the chat about taking a look at history and what happens. And we have taken a look at history a little bit, just in regards, not like 1970s back, but
I'm happy to jump into the 1970s stuff, because the 70s were a very complicated time, right? Like I don't know, something happened in 1971 if I remember, but I just can't quite put my finger on it. It had something to do with gold, right? And a gold standard, and all of a sudden we weren't on a gold standard anymore. So actually, you chat about recent history. I'm going to pull up a couple of charts here real quick, just to talk about the 1970s. So yeah.
I'd love something I want to touch on quick, just while you're pulling that up, just to make sure people understood what I was saying in terms of the discounted rate on variables. Current prime rate is 2.45%. So if you're already locked in at a variable rate, your rate won't change unless that prime rate changes. But for borrowers who are looking to refinance or purchase, the lenders have what they call a discount on that prime. So your rate is typically prime plus or prime minus. Lenders can easily change those on a day-to-day, and it won't affect current terms, but it could affect someone new coming into a term. So just to put some clarification there.
Yeah, I appreciate that. And so I'll just jump in here and do a screen share. So I follow a lot of, Bitcoin maximalists on Twitter and stuff. So, I'm going to give a bit of the commentary here. CBS correspondent with 1.3 million followers is on a path of Socratic self-discovery. This is an amazing collection of graphs. What did happen in 1971? And it's just like, 1971. And we can see how it appears like things kind of got decoupled there when we went off and just started using silly money. So while I don't disagree with you or the sentiment that you shared here, the quote from Steve Eisman, that leverage is mistook for genius, 100% agree. And yet at the same time, we need to understand that we live in an environment where I would argue, and now we're really getting off real estate and mortgages, but I would argue the closer you get to the printing press, the closer you get to the source of leverage, the better off you are, like in this form of crony capitalism or whatever sort of framing you want to give it. But like this graph should be concerning, right? This idea that real median weekly earnings of full-time workers literally was keeping pace with everything right up until there, and then immediately started plateauing. Average real wage, again, average real wage with GDP deflator, real GDP, and then real GDP per capita, right? Like it's shocking to see that decoupling. And I actually don't remember what these other charts were, but again, it's just like, the 70s were a crazy time of a lot of volatility, and it's got to do with a lot of things, but it definitely has to do with our modern approach to banking as well.
And I can really, if you take a look at graphs currently at the moment as to what's happening with the printing of money and what's happening with the economic policy, it's not difficult to see that something is going to have to change with our monetary policy to combat what is happening, whether that's trying to find a way for people to trust the dollar again, or creating a new global standard of currency that is actually backed on something. I'm not too sure exactly what's going to happen. You know, people much smarter than me are sitting around tables trying to figure that out right now. But we have an entire generation
of people. Don't give them too much credit, though, those people around those round tables either.
I think we have too many people now who are smart enough to understand what sound money is, and they are starting to realize that what you go to work for every day can be printed into oblivion. So choose the assets that you are going to invest in very carefully, but invest in those assets and make sure they're hard assets, whether that is digital assets, if that's something you believe in, or real estate. But the dollar, unfortunately, is dying by its own creator. It's being printed at a rate much larger than anything we've ever seen or experienced. So I think just prepare yourself the best way you can and do it in a smart way. You know, don't listen to anybody. Listen to yourself. Do your own research. It's coming whether you want to stick your head in the sand or not, though.
Yeah, absolutely. And really appreciate that perspective. And I just thought, since we were talking about Bank of Canada, it's been a while since I shared on a live stream just what's going on with their total assets and liabilities. And I actually see there was a tiny little bump that occurred recently. So I wasn't necessarily expecting that, but I don't really see what drove it. It looks like maybe a little bit of the provincial bonds was part of it. And then otherwise just the Government of Canada bonds being purchased. But I think, this also says a lot. It realistically, to understand modern economics, I feel like you do have to spend a lot of time reading, a lot of time researching. And, at the same time, it's fun to intellectually talk about all this stuff. And I do think it adds a certain perspective for me as a real estate investor. At the same time, I don't think you need to know a lot of the stuff that I kind of went on tangent on, or that maybe some of the higher level stuff we've been talking with you guys about. I think what is really important as an investor is focus on the fundamentals, right? And I forget whether it was Josh or Ehren that mentioned it, but stress testing your personal portfolio. Yeah. That's what's actually important, right? Can we actually handle a 2% interest increase? Because if you can probably weather some decent little storms there, right? And as well, one other stress test that I personally like is like, can we see a slight reduction in average rents and that increase in interest rates? Because if that's the case, that really feels like a safe investment, in my opinion. I know when I originally started, I'm maybe a little bit less risk adverse than I was when I originally started. But when I did start, I was often running the numbers of 2% interest higher just to make sure that I could cover it, as well as looking at 80% of my expected gross rents. If I could break even from a cash flow perspective there, I felt very comfortable moving forward on the investment, because it felt like, I was kind of covering my two big vulnerabilities, my cost of debt or borrowing, as well as my gross income or my source of income to pay that debt. So that's how I did. I don't know if you guys have any rules of thumb that you use or that you recommend to clients, but that idea of personally stress testing your portfolio is very important.
Yeah, I mean, every file that we do is automatically stress tested, right? For example, right now, uninsured, homeowner rates, like primary residence rates, you can get a 1.55 variable. You're still qualifying at, as of June 1st, 5.25%. That's well above 2% on there, right? So that stress test is implied, when we do the application right from the source. One thing that I would say take a look at is, if you're planning to do a BRRRR, stress test your rents and what your expected ARV is, and what's 75%, what's 85% of that. Because, the big thing that I think, a lot of people seem to forget is it's great that you go in and you do this huge BRRRR and you pull out $200,000 in equity. But now you have this, if you're pulling out 200 in equity, your mortgage has gone up by another $200,000 at what could be an increased rate, depending on how long and how the market swung. So, even if your rate stays the same, what does that look like when you take out an additional $200,000? Are you just sitting on cash flow positive, or do you have a decent amount of cash flow reserve on that? Because if you're just sitting on the borderline and you complete this sweet BRRRR, you're probably going to be cash flow negative afterwards, and now you're cash flow negative. So what was your goal to begin with? Are you getting in for cash flow, or are you getting in for the appreciation, more of like that GTA market type buying? If your game plan is cash flow, make sure that refinance is able to support it. If not, you lose that within 6 months. So you were in and out on a burn in 6 months, you lost your cash flow in 6 months. So, depending on what your strategy is, just make sure you're looking ahead a little bit.
Important to note that we qualify a person based off of their personal income. So if you're a high earner and you have a high income on your application, you don't necessarily need to have a cash flowing asset to get a mortgage. No. So, we don't qualify your mortgage based off of if it's cash flowing or not. We qualify it based off of your total debt servicing ratios. So you could have an asset that's cash flowing great, but another asset isn't cash flowing. It doesn't have to cash flow for us to give you a loan. So it's really dependent on your specific, investment strategy as a whole as an investor. If you're okay with having negative cash flow on one property but positive on another, that's fine. And we run the numbers based off of getting you into the loan and the requirements that need to be met. So you might not you could be in a situation where you can get a loan without the cash flow on the property. So if cash flow is important to you, understand that doing that personal stress test, as you said, is going to be really important for a lot of investors. And I was just talking to a client today how I do foresee if rates go up, quite a few people are going to be in a situation where they might want to take a look at moving to a fixed rate before that happens, because all these variable terms are great for flexibility and being able to restructure debt within a short period of time. But taking on that fixed rate as an investor when you start seeing markets move in a way that you aren't necessarily ready for, is extremely prudent. You don't want to be stuck in a situation where you have negative cash flow and you can't necessarily get out of it, and then you're working for your investment at that point, not the other way around.
Yeah, absolutely. It all of a sudden being an investor is a lot less fun under those circumstances. So it's so important just to go into those transactions eyes wide open, understand what your exit plan is or what your exit strategy is or what plan B and C look like. Don't just focus on plan A, because sometimes it can be easy to trick ourselves into looking on the rosier side of things and using only the best case scenario numbers, especially in these competitive environments with these competitive offerings. And the FOMO is still very strong, even if we are starting to see a bit of a plateau in certain markets. I think that FOMO has been essentially just mainstream media has really drilled it into the average Canadian. So make sure that you're not just being emotional when you're looking at making that purchase, but make sure you've ran the numbers, you understand the implications of what you're getting into. But at the same time, that's not to make this all sound scary. No. If you guys have been watching my YouTube channel for the last 5+ years, there's a lot of people that have done very well with real estate investing. But a lot of them, I'm trying to think, there's very few just like speculators I've led on the channel. So just about every single one of them has focused on cash flow, return on investment, not just counting on the greater fool theory, which is just hoping that some other fool will come along and pay you more than what you just bought it for. That's pretty much my approach with NFTs. I'm crossing my fingers on
the last 6 months. Like the last 6 months, if you bought something, you definitely made enough money to sell it to somebody else. But it's not a long-term strategy, guys.
Yeah, absolutely. Awesome, guys. Well, as we look to kind of wrap this up, reminder, contact information's in the video description down below. So if you guys want to reach out to Josh or Ehren, I'm curious, do people play favorites? Are they just only reaching out to one or the other? Do you guys keep tracks? I'm imagining there's just like a tab in the back, a whiteboard where you guys have it like just, I got another DM today, Ehren, and just like back and forth. But
we don't specifically keep tabs. No, there's a lot in general. There's a lot of applications in general. We've each kind of just developed our own little, not like specifically niche, but just our own little like customer referral base based off of each. So, and it's funny. And the more we start to refer, the more it starts to get back and intertwined. And, everyone kind of knows someone. So, we'll have people who actually shop both of us. Like we've had
play you guys against each other.
Yeah. Well, we had one for a lot of people who don't know, like Adam Martin's on our team. We actually had a file where it started out with me, it went to Josh, and then it went back to Adam. And I'm like, you went to the 3 same people all on the same team. Like if you're going to shop, do some research on the people you're going to first before you go and shop us to our team.
That's funny.
Your time. So
funny times.
But
awesome. Well, again, appreciate it, guys. Again, contact information in the video description down below. It is important that you've got an expert when it comes to financing on your power team as a real estate investor. Financing is a big aspect of these deals, and not just financing the deal, but being able to do it fast. And this is something that myself and Jeff Weibo have said pretty much since day one as real estate investors. A fast yes, that's awesome. But also a fast no is great, because that at least gives you options and to move on from it. Where the slow no, the slow no is what kills deals. And honestly, that's what I think that you get when you deal with people that aren't professionals or people that don't regularly deal with investors. They kind of cross their fingers and they hope they'll stumble into some sort of option for their client. And it doesn't play out that way too often, in my opinion.
Completely agree. Yeah, the fast no is key to executing with speed. So, if you have somebody humming and hawing about an option, it's probably not the right person or right option.
Awesome. Well, thanks again, guys. Appreciate you hanging out with us on a Friday on a long weekend. I'm not sure if we weren't in quarantine, I would have got you, but I'm glad that we were able to get you on the show today.
Yeah, I really appreciate you guys having us on. Really looking forward to the next time we do this, Matt.
Absolutely.
Awesome.